take a step back from the individual companies for a second here, and let's just do some like broad general education on the EV market. For that, let's turn to Matt Timpane from Schaeffer's Investment Research. Matt, hey, there he is. How we doing today?
Not too bad. How about yourself?
Doing okay, doing okay. We are going to talk, so far today we've heard from like 15 companies. We've heard from the companies themselves, but let's get a third party's opinion on companies they like in the space. And for that, we'll turn to you. So we've got your slides here. Let's bring them up on the screen. Let's see what opportunities you can find for us, Matt, in the EV market.
All right, wonderful. As you said, my name is Matthew Timpane. I'm a senior market strategist over at Schaeffer's Investment Research. We've been providing options research, education, and news to retail investors for the past 40 years. We're based out of Cincinnati, Ohio, and we kind of take an exceptional analysis look at opportunities, whether it's other sectors or EV markets. As you know, as a trader, we do like volatile markets, so the EV market is right up our alley. We're in and out of the sector or the industry on many trades, upside and downside. So today we wanted to kind of give you a trading perspective from this. So we're looking for electric opportunities in the EV market. One quick thing that I would like to just kind of go over quickly, these 2 weeks that we're in kind of right now after September's options expiration week is one of the most volatile periods of the market throughout the year. When we look back on a 10-year horizon, we're roughly down about almost 1% through the end of September. But it really shouldn't scare you in the long run because through October, we're actually up almost about 1%. So, what we kind of like to look at this is it's volatile, but it's an opportunity possibly for areas of the market to be able to buy. So the EV market, in specifically even the speculative EV space, we actually aren't seeing that much volatility in that area because they've kind of been through a consolidation and correction phase throughout most of the year. So we're actually seeing strength in some areas there. And on the sell-offs, they're not selling off as much as other things that have appreciated this year. So we could be seeing possibly larger term bottoms in these stocks where we could get some of those big rallies that we're seeing last year prior to 2021. So just kind of a broad, quick market overview. I'm sure a lot of people know a lot of this information already, but for those of you that don't, governments, are across the globe are just making a major turn towards fostering low carbon society. So the EU actually has announced on July 14th a proposal that will effectively end the sale of all passenger cars except for EVs from 2035 going forward, with a gradual phase out of internal combustion engines and hybrids over the following 10 years. Biden also signed an executive order on August 5th to target and make half of all new vehicles sold to be in 2030 emission free. This is really kind of consistent with his goal of building more than 500,000 EV charger stations throughout the country, along with $7.5 billion earmarked in an infrastructure plan to make electric public buses and transportation as part of that larger infrastructure plan. Japan is also targeting 100% electrification by the year 2035. And the UK in the past year has accelerated their sales ban on internal combustion vehicles to 2030, and hybrids will be in 2035. These are the type of goals and legislative maneuvers that are causing many of the Wall Street's investment banks to raise their EV demand forecast by as much as over 20% for years 2025 and 2030, as they now kind of expect the EV uptake to advance quicker than previously expected. To me, sometimes it's the personal interactions that can really make you see that adoption of certain technologies will be much greater than most expected. For me, this is actually when my father, who's a Vietnam War veteran and a miner for over 50 years, who's amazingly still working, kind of grew up during that classic muscle car era, the 50s and 60s and 70s, leans over to me and goes, "That new electric Ford truck looks badass." I mean, that's kind of just a big signal to me. One thing I would say out there that I just kind of put as like something that you might want to put on your horizon for a concern, we're going to expect a really tight supply for batteries, I think, with demand increasing possibly, to the hyper adoption scenarios, that supply could get pretty tight. So while the cost of making battery cells has declined 97% over the last 3 decades, there's still a small risk that, commodity inflation, if that's really here to stay, it could be the first time in a very long time that you actually kind of see some increase in battery prices. I wouldn't worry about it too much, though. This possibility, I would just put this as an outlier that something just always keep on your radar. Let's get to the charts. One of my favorite ETFs to get into the space for longer term accounts, IRAs, or long term, even individual joint accounts type of thing is Autonomous and Electric Vehicles ETF, DRIV. It already has over $1 billion in total assets. It's up 67% year over year. Tesla is the top holding, but in my opinion, it's a very well diversified ETF for long-term exposure to the EV industry. Companies include major auto companies, semiconductors, battery and fuel cell power, plus material and other component providers. So you even have companies in there like Apple, Microsoft, Google, NVIDIA, Freeport-McMoRan, that can help keep the ETF stable when the EV specific companies kind of hit a rough patch. But you're still going to be able to gain exposure to speculative EV stocks like Geely or Quantumscape. So as you can kind of see, it kind of moved far away from like a technical perspective from that 200-day moving average. That's exactly where it kind of bottomed recently. So this consolidation was really warranted over the past year as it's moved so much from those pandemic lows. If for some reason we do get a move lower as we go through this volatile period, I would probably target the 10% year-to-date area here on this chart. It's the $25 to $26 range area. As you can tell, it's found support there multiple times. So that's where I would do it. Probably put like a stop down at $24.50 because if for some reason we do kind of break below this area, there's a good chance we probably go to the $20 level. That's that old 161.8 Fibonacci extension level. It's a 50% kind of retracement level from trough to peak here, from those lows to highs. So it makes really sense that that'd be an area that you would go to if for some reason we broke down. Looking at it from a relative basis, you can see it's been consolidating as the S&P 500 has been outperforming. But it's in a classic, lower high pattern. If it kind of breaks out of this is where I think the ETF once again will start outperforming the broader market. If we head over to another ETF, the lithium ETF, LIT, this is up about 25% year to date. It's another great ETF for that long-term exposure that you want to the EV industry. It has about $5 billion in assets. Two of its largest holdings being Albemarle and BYD are two companies I'm pretty bullish on in the long term. So LIT recently found support, oddly enough, at its 20% year-to-date level. That just happened to be that 80-day moving average. Throughout time, this has been a significant moving average for the ETF. So you can see that it kind of caps gains here when it's kind of going through little bearish phases, and it's also marked plenty of bottoms throughout time when it's in a bullish phase. So this could be the spot right here. Could have just been it, and we could be going higher. But if we did break down, the next area I'd be looking for is the 75 mark. It's kind of in that longer term uptrend from that pandemic low area. You'll have a rising 150-day moving average there. And it's kind of that 361 Fibonacci extension level. So it'd be logical. We already found support there once earlier in the summertime. And so that could be a good area to add exposure to this ETF. Again, just pulling up a relative chart. Many might call this double top. I don't really like doing chart patterns really on relative charts. I would look more for like horizontal support and kind of resistance levels, but you saw it kind of form this big base area here. So even if it pulls back a little bit, you'll perfectly fine. If it breaks out over this level, you'll start seeing that outperformance once again in this in the lithium ETF. As I don't think this is a move it's going to be going anywhere shortly. It's going to be around for a long time. So I know I probably missed a few companies here on the EV automotive returns. I think Lee Automotive, a few others, but I just kind of want to give you an idea of what every company's been kind of doing that are specific to the cars and in the automotive industry. So on a year-to-date basis, another thing is, GM is targeting selling only emission vehicles by 2035. And then Ford is targeting, I think it's 40% of new vehicle sales to be fully electric by 2030. Volkswagen is 20% by 2025 and 50% by 2030. So, you don't want to ignore the old dogs that are out there. So the new kids on the block are really attractive since there's so much more upside in the EV space. But you can't forget about the stalwarts. They have capital and the ability to ramp up infrastructure and be able to supply the public the demand that they want. So diversification, in my opinion, on longer term portfolios and even shorter term is a way to go when playing the EVs. The real standout this year has been Lucid, as they are targeting a production rollout by end of year and is now up 167% year to date. As of yesterday, I believe that's kind of closer to 150% year to date today. Ford also kind of stands out to me as, they're going to be the first truck to market, as you know. That's something that my father loved, and for somebody like that to say something like that, you got to kind of take recognition of that. And we know America loves trucks in general, so I think that's something you'll want to keep on your horizon when you're looking for building a portfolio around EVs. Battery and fuel cell power year-to-date time frame is kind of sitting here. Some are up, some are down this year. It's kind of been a mixed bag. Last year's big winner was Blink, which was still up 270% year over year. But this year it's kind of struggled, and we're seeing other winners emerge in the space like Albemarle, Livent, Lithium Americas, ticker I believe is LAC. So you're seeing some movement around. What you'll probably likely want to do is towards the end of the year start looking at the dogs kind of this area as funds may try to get back in after a year's worth of consolidation or pullbacks in some of those ones that aren't doing so well this year. And then I want to throw this quick slide out here because EVs, when they're in, a bear market, whether it's cyclical or secular, you can always still look for exposure to the industry through semiconductors to at least gain a little bit of that exposure that you want in your portfolio. It's not something I'm going to elaborate too much on, but the standouts to me would be NXPI on Semiconductors, Skyworks with a recent acquisition of SLAP, and TSM, as they're going to likely be needed to provide more low-cost chip manufacturing. As the automotive end markets will grow, their management actually recently stated that their segment is on pace for 20% year-over-year growth. So get some charts up here of some companies that we like. Wouldn't be a conference without looking at Tesla's chart. It's kind of sitting here in this channel, going back and forth after finding this base here. Oddly enough, from a trader's perspective, what we saw was this was minus 20% year-to-date level. Now it's just kind of riding this channel up and down. Finding support will break through the 200-day level, but right now it's at year-to-date break-even. It's kind of been holding that even amid this volatility the last few days. It's also got the rising 20-day. As we know, it does love to hold on to that in bull rallies. What we really want to see is a breakout above this 70-80 level here. That would really probably get Tesla going again. But there is good catalysts. I mean, you have a buy to open 10-day put call ratio at 0.92. That's in the 89th percentile. Options are pretty cheap. They're being priced in the 6th percentile. And we have a massive peak put level down at the $700 level right here, which is right in this channel and with that 200-day moving average. If we did for some reason break below that level, that's when you'd want to kind of just get out of it, stop out of it. You do have significant downside risk then when it breaks those peak levels. So, we could easily see 560, 580 range or even 500. But, analysts are very still mixed on Tesla because it is outperforming and it's an expensive stock, but it's expensive for a reason. So those are our thoughts here on Tesla, and let's look at a few others. One of my favorites is Lucid Motors. Obviously, it's been in the news a lot lately. Wall Street Bets is kind of getting on this now. So unfortunately, they beat me to it before I could get to you guys. I had this planned, but it recently broke out of its downtrend after finding support in its base of the $17 range area here. Now it's back above all major daily moving averages. And today it's kind of pulling right back into this 150% year-to-date mark. around 25, 24. If it continues to hold this, that'd be very constructive in the short term. We could see a continued move up to at least the $30, $31 range area. That would coincide with the $20 billion market cap, which is a round number. You can kind of see kind of always hesitated here on those levels as you kind of move up. But, I also wouldn't be surprised if you kind of just see a little snapback down here, this 200-day and 50-day moving average, fake a lot of people out before it goes higher. So I'd be nimble with it. But, I think over, the longer term and even into the first half of 2021, I don't think $40 is not is not out of the cards. It easily could go right back to $40 by the first half of next year. Green hydrogen and fuel cell technology company Plug Power is another one that we like. It's kind of riding this 80-week moving average, finding support there. It's at the 100% year-over-year level. It's got this little wedge breakout for technicians. Short interest is almost about 10%, 9.5% right now. And it's kind of at its summer highs. If it rolls over again, it easily could create a nice little buying opportunity for everybody. We use a volatility scorecard that tells us how options are outperforming like straddle plays. That's actually in the 100th percentile. So that means it's always outperforming the expected volatility. And then options are pretty cheap too. They're in the 9th percentile. And our open interest ratio is also in the 99th percentile. So there's a lot more puts out there than calls. Another interesting thing is this $25 level is kind of a massive peak put level that should be supportive going forward. So I would probably target a move in the short term to 33, 34 area, which is the $20 billion market cap level, where you could probably see some hesitation, but it definitely has the ability to go much higher than that. And then finally, an additional company that I threw in here last minute as a bonus, something that we're kind of looking at. It's extremely speculative from the standpoint from a trader's perspective right now, but Quantumscape is finding kind of support level where it gapped up and ran to when the SPAC announcement, what company it was. And it's kind of just, kind of now been consolidating there now for about 3 months. I would look for a signal for a move above that 20-week moving average that I put on here. That would kind of give you the go ahead to buy this, I think. It's got a volatility scorecard of 86. Oddly enough, right here, we're at like a very specific pivot point. It's at plus 50% year over year level and a minus 50% year to date level. These are areas stocks like to kind of stall, hesitate, find support, find resistance. Short interest is near its all-time highs at 8.9%. And options, for an options trader, if it did break out, options are cheaply priced. It's not the most cheapest option in general, but in its range, it's priced in the 13th percentile. And you could easily see a move, I think, back to the 40 range area. So that's it for me. Thank you for your time. Feel free to come over to schaeffersresearch.com. Check us out. We always got good material being put out there regarding the options industry. Give us a follow on Twitter at Schaeffers and at Timpane. We're always willing to engage, and we're always trying to put great content out there for everyone.
Thank you, Matthew, for the thoughts and the analysis. Guys, drop a like in there. If you haven't already, hit the thumbs up button. Do it for Matt, and it would make me and him feel a little bit better.